Good morning, everybody. Ed Yardeni here in Long Island. We've had quite a bit of rain, not as much as some other areas around the country that have been totally flooded. But sprinkler company called up and said that they want to open up the sprinklers, and I kind of said, well, why if we're going to keep getting rain like this? But they're coming, which means that spring is coming. So in the spring there will be growth, as Chauncey Gardner once said, and so we're looking forward to a nice spring here in Long Island, and I hope it's nice wherever you're located. We're have the good fortune of having Max join us again, so he's watching over our conversation, and we'll see. Last time he left early on, so it must have been kind of dull for him. But at any rate, we'll have lots to talk about this past week. We had Fed Chair Powell basically reassure us that we're not far off from having the Fed lower interest rates. Far off could mean a few months, could mean, I think it means certainly before the end of the year, and it doesn't suggest the end of the year. It suggests sometime before the middle of the year, or maybe early in the summer. But in any event, it was quite reassuring, and as a result of that, we've had a nice continuation of the bull market until Friday, really. And now we seem to be finding some buyers of stocks like Nvidia. The semiconductors got whacked on Friday. I don't know if Kathy Wood had anything to do with it, but Kathy correctly observed that semiconductors are very cyclical, and they do tend to have a cycle where there suddenly is a lot of more demand than there is supply. And when that happens, companies scramble to double and triple order. And then wouldn't you know it, supply catches up with demand, and suddenly the demand isn't as real as seemed to be, as some of these double and triple orders get knocked down, get pared back. And so that's something we want to keep in mind when we get excited about semiconductors. I mean, clearly, that's the way to play the roaring 2020s, is clearly the way to play technology leading the way in boosting productivity in order to offset the shortage of labor, particularly skilled labor. But it's prone to being cyclical. And now that it's so popular, and the GPUs and other semiconductors are in such short supply, we're getting the double and triple ordering. And it probably won't take all that long to get some of the supply back up and get the orders cutting back. So something to keep in mind. That doesn't necessarily mean that these stocks aren't going to continue to outperform over the rest of the decade, which I think they will. But it sometimes can be a bit of a bronco ride. So we'll see how that plays out. Anyways, so Fed Chair Powell was actually very dovish. And the market reacted accordingly. And then the Fed president of the Atlanta Fed, Bostic, delivered a speech in which he kind of raised some interesting questions here, which I think Fed officials, including Fed Chair Powell, need to think about carefully. And basically, he came up with the concept of pent-up irrational exuberance. He didn't say irrational exuberance. He said pent-up exuberance. And he said that he and his staff have been calling around to businesses in the Atlanta Fed districts, and he's been giving speeches and basically asking the question, folks, for those of you in the business community, if we start lowering interest rates, what might you start to what might be your reaction? And the feedback that he got from the audiences and from the surveys, informal surveys they've been doing, is that there's a lot of pent-up demand by businesses to expand, to spend more on capital, on technology. I don't know that he said it so much on labor, but he seemed to be focusing on the demand for capital goods by businesses. And the feedback he seemed to get was that as soon as the Fed starts to actually cut interest rates, there's going to be a surge in demand by companies to invest in the good times that are ahead. So he kind of warned against acting too rapidly here with cutting interest rates, and I'm in that camp. I agree. I mean, my motto here, my mantra is don't mess with success. The economy is doing just fine. I know every now and then we get some controversies about that. We can talk about the payroll numbers in a minute, but the economy seems fine, and the inflation still moderating. Bostic, in his pent-up exuberance talk, stressed that what he's concerned about is that if we suddenly get a burst of kind of a boom, a business boom resulting from the first rate cut, that it could lead to a rebound in inflation, and that would be troublesome. So he basically said there's really no rush to lower interest rates. And again, I agree with that scenario. Why mess with success? The economy is doing well, inflation's coming down. And I think the Fed really has to be concerned about something that that Fed Chair Powell didn't seem to be concerned about at all. And that is not pent-up exuberance, but which is a concern, but irrational exuberance. The possibility that we've already got some very strong financial markets, financial conditions have eased dramatically here without the Fed even starting to lower interest rates. And so, again, what's the rush? If the financial markets are easing, maybe that means that the Fed has even more time to keep interest rates where they are right now. It's been my belief that while the Fed certainly has tightened from 0 to 525 basis points, 550 basis points on the Fed funds rate, that obviously is a significant tightening. And it's probably one of the main reasons that so many economists concluded that it had to lead to a recession. I also observed that actually, don't forget where the Fed tightened from. They tightened from 0, and 0 was a really great abnormality in our financial markets over the past few years. And what the Fed really has done is not just tighten, but it's also normalized. Maybe interest rates are where they should be. Maybe they don't have to go higher, but maybe they don't really have to go much lower. And a bond market with a yield of just something north of 4% is normal. It's what we had before the great financial crisis, where everything abnormal happened with monetary policy between the great financial crisis and the great virus crisis. So that's where I'm coming from, and we'll see how Bostic's thesis plays out in terms of whether other Fed officials will pick up on it. But again, Powell, I think, might have actually jumped the gun a little bit, because the message that the Fed and Fed officials were providing before that is we're going to lower interest rates, but we're in no rush to do so. And it's going to be 2, maybe 3 rate cuts. It'll be very interesting to see what the next summary of economic projections looks like when the Fed comes out with them for the June session. It's a quarterly poll of the various Fed officials at the FOMC, and we'll see what they come up with. I will not be surprised if they push back on the market and reiterate 2 to 3, or actually say maybe 1 to 2. A lot can still happen between now and then. Tomorrow we get the CPI. I think it's widely expected that the top line CPI will be up 0.4%, and that that's the headline, and that the core will be up something like 0.3%. A little bit on the hot side, but some of that, of course, has to do with price of gasoline has actually been increasing in February, so the February numbers may reflect that. On the other hand, food inflation, at least based on what I see in commodity prices, seems to be moderating, so that should be somewhat helpful. But clearly, we still have some issues on the services side. But once again, we will look at the headlines CPI and the core CPI excluding shelter, which we all know has got some issues with it. And what we expect to see is numbers once again around 2%. So the CPI inflation rates, which, by the way, on a trend basis, tends to be somewhat higher than the PCED inflation rate. But the CPI inflation rate should continue to confirm that inflation's come down. And I guess some of you may say, so why not lower interest rates? And the answer is, why should they lower interest rates if everything's working out just fine? Unless they really think that if they keep interest rates here, then lower inflation is going to mean that the real interest rate is going to become restrictive. I have a problem with that real interest rate concept. First of all, the notion that you can take an overnight Fed funds rate and adjust it for a year-over-year percent change in the inflation rate, that seems pretty cockamamie. I have not a clue what that means. I can't imagine too many businesses or consumers plan their lives around the real Fed funds rate. The other thing is, once you start talking about the real Fed funds rate being restrictive or easy, it's compared to what? And so the answer is compared to the so-called neutral rate, which is a complete and total theoretical construct. It's impossible to measure. No one knows where it is today. No one knows how to measure it. No one knows whether it's relatively constant or whether it's quite variable. I mean, I'm thinking about the neutral rate in the context of my roaring 20 scenario. And so here, inflation is going to come down to 2% and stay there. Maybe we'll actually start worrying about some deflation because goods inflation gets moderated or deflated by China. So we get some really good inflation news. Well, shouldn't that mean the bond yield should come down? Shouldn't that mean the Fed should lower the Fed funds rate? Well, what if the reason this is all happening is because we're getting a big boost in productivity growth? That's my thesis, is that we're going to have a dramatic increase in productivity growth. In that scenario, what should the real rate be? I mean, if productivity is growing faster, that means real growth is better. It means that inflation is lower because unit labor cost inflation will be lower. I mean, wages are rising faster than prices. It's good for profits. So all these good things are happening with better than expected productivity. Doesn't that mean that the neutral rate is actually higher, that the economy can actually live with higher interest rates, can continue to perform well? So again, to me, it's more confusion than it's worth, this theory of neutral rates and real rates. But hey, that's just me. What matters is what the Fed thinks. And if Fed officials like Fed Chair Powell think that, well, if inflation really comes down to 2%, we really have to lower the nominal Fed funds rate because that means the real rate becomes restrictive. We'll see. We'll monitor it. We'll see whether. I mean, Powell has himself acknowledged these very same issues with the real rate, the neutral rate in particular. So with all that, let's move on here and look at the charts. My bottom line is I think the economy is going to continue to grow. I think the consumers are in good shape. There's a very positive wealth effect emanating from home prices being at a record high, the stock market doing very well, consumers' household net worth is at an all-time record high, and the job market continues to create jobs. A lot of them are being created in the areas where baby boomers are spending their money in retirement, which is on healthcare and leisure and hospitality, and that's going to continue. So let's go to the charts here. And let me share with you. All right, so March 11th is today, this morning. And so there's quite a few charts here that I'm going to breeze through on inflation. Again, my thesis is that inflation turned out to be mostly transitory and not persistent after all. I know there's still some people out there calling for a warning about a potential for a twin peak, so that inflation has come down the way it did in the 70s, and then it went right back up the way it did in the second half of the 70s. I think a lot of that had to do with two energy spikes, and I guess that's conceivable. Again, if things really completely unwind in the Middle East, not that they're haven't unwound already, but there's still potential for things to get much worse, unfortunately. But meanwhile, the price of oil has gone up to a limited extent, because I think that's a risk premium, a geopolitical risk premium. But it certainly looks as though, from a purely supply-demand standpoint, there's enough weakness in Chinese demand, European demand for oil, and there's a lot of production in North America, that the price of oil isn't going to go surging higher. So this is our long-held inflation forecast, and It's one of the few that I haven't had to change for a long time. So here is the 2022 uh, uh, inflation performance, and we started to indicate what we thought would be the inflation trajectory, and we kept these forecasts up to here have been intact since 2022. So things have worked out very well. And then last September, we started talking about this year and next year, and said, we thought we could be down to 2 to 3%, and we're already basically there when you look at the consumption expenditures deflator. So things are certainly going in the right direction, and I think they'll continue to do so. This is just a longer view of the inflation story. Let me skip that one. The next two are basically looking at durable goods and non-durable goods, and back here, durable goods inflation had that Twin Peaks. This time around, it spiked up and came right back down, and it's doing what it has been doing since the mid-1990s. It's deflating. So there has been a strong tendency for consumer durables inflation to actually be deflationary. And some of that had to do with China. Some of that had to do with productivity and technology and manufacturing, and or the speed of innovation of new kinds of consumer durable goods that have been introduced, particularly in technology. So that tends to lower the prices of the old versions of these things. And I think that the dynamics of that is that technology has become more important to consumers, and there's a lot of deflation there. But you can see that we're now back in deflation territory, so it's not even close to anything like this. And this will continue to be an important reason why inflation has come down and stays down. And we may actually, at some point here, once the services inflation rate, particularly for rents, comes down, we may start to see the central banks worrying about why can't we get inflation back up to 2% again. Hopefully they'll chill about that and realize that zero inflation, even some deflation, isn't a bad thing if it increases real purchasing power and if it's based on productivity, which is our story. This is non-durable goods. Well, what can you say about that? It's very volatile, dominated by basically commodities, food commodities, and energy commodities. And you can see that inflation rates come down. Ag price inflation on a year-over-year basis continues to come down based on the S&P Goldman Sachs Ag Index. We'll be covering that in the morning briefing for tomorrow. And on the other hand, energy prices have been increasing somewhat. But add them all together, and I don't think we're going to have another spike like this the way we had back here, barring, of course, the geopolitical hedge clause that I gave you. This is the main housing services components, and you can see that housing and utilities inflation has come down, but it's taken its sweet time coming down. The tenant rent, owners equivalent rent, same story, but they're heading in the right direction and should continue to moderate. Back here, we had some moderation, but didn't last very long as inflation started surging again on rising energy prices, which went straight into wages through cost of living adjustments and so on. Let's see what we got here. Figure 6. We've got the Fed Supercore. So Jerome Powell told us that we should look at the goods inflation rates, which he says looks fine. He said we should look at housing inflation, which he acknowledged has some measurement issues, but that looks like it's going in the right direction. And then about the beginning of the year, most of last year, he was saying, yeah, but we're concerned about he didn't use the word supercore, but it's come to be known as a supercore. And this is the PCED services, less energy and less housing. And so it's the non-housing, non-energy services inflation rate. And it seemed to be very sticky at 5%. And then it came unstuck, and it's now down to 3.5%. So I haven't heard Powell talking too much about the supercore of late, but it's going in the right direction. Some people freak out because on a year-over-year basis, there's a little move higher here, but that's not my style. My style is to tell you that I think it's still heading lower. The Bostic, by the way, in his speech, talked about the Dallas Fed PCED trimmed, and he said he's showed some concerns that that was starting to get somewhat sticky. I'm not a big fan of these alternative measures of inflation. I'm perfectly happy just working with all the data we have on the official PCED and CPI. But even these numbers on a year-over-year basis are coming down. But it's easy to find trouble if you're looking for it. You know, all you got to do is look at a 1 month number and annualize it for health insurance or motor vehicle insurance or whatever. Again, it's the forest and the trees. The Fed's job is to bring overall inflation down. It's not to micromanage individual components of inflation. And there's, as Powell said, there's not much that the Fed can do about motor vehicle insurance, for example. So it's the overall inflation rate that matters. And it's okay to take out some components as long as they support my story. I've been telling that one for a while. But I have no problems taking out shelter and energy and food, but that doesn't mean I don't look at the other components as well. This is another way to slice and dice the consumption, the PCED core, ex food and energy, 12 months, 6 months, 3 months, and they've all, you'll notice, have two handles. They're all under 3%. So we're definitely getting closer to where the Fed wants to be. Well, what the Fed, I think, needs to pay more attention to is a third mandate, which they don't have. Their mandate all along should have been, it should just be inflation, just to keep it simple. But if we're going to complicate things and say their mandate is a dual one for inflation and unemployment, I think they got to add a third mandate, which is financial stability. And that's the one they kind of consistently overlook. And I think they're a little cocky here because they figured out how to play whack-a-mole in the financial markets and provide liquidity whenever there's some sort of financial crisis. They learned how to play that game back in 2008, 2009. And when the pandemic hit, they played whack-a-mole again and came up with liquidity facilities very, very quickly that stabilized the financial markets very quickly and led to a surge in stock prices. And now last year, we had a mini banking crisis. It basically occurred on a Friday, March 10th. And on March 12th, that Sunday, they already come up with a liquidity facility. So they took out their whack-a-mole hammer and hammered down that banking crisis very, very quickly. So they do have this view that they can deal with liquidity issues, with financial crises, with these tools that they have, and that their mandate is inflation and unemployment. But I think financial stability matters. They keep talking about financial conditions, and you have to look at the whole picture. I think Goldman Sachs has a financial conditions index. We just as soon look at all the various components. So let's look at the components here of financial stability. We have the stock market capitalization. The S&P and the Wilshire all-time record high in terms of stock market capitalization. The Fed just came out with its fourth quarter flow of funds data, and that shows that the value of all equities traded in the United States are $78 trillion. It's serious money. This is another indicator of financial conditions, and they certainly don't look particularly tight when you look at the valuation multiples. The valuation multiple on a forward basis for the S&P 500 is 20.7. It's looks like it's heading towards 30%, 30, I should say, for the technology area. That's still not irrational exuberance to the extent that we saw back here, but it certainly suggests that financial conditions aren't restrictive, aren't tight. Another indicator of financial conditions is the yield spread between the U.S. high-yield corporate bond and the yield on the 10-year U.S. Treasury bond. And you can see that this does an excellent job of telling us we're in a financial crisis. The only problem is by the time we get the news, we're in it and there's not much we can do about it. And things have already kind of reacted. Stock market takes a dive, corporate bonds take dives. But it does come out every day. So from that perspective, it gives us more of a read. But sometimes it can be hard to read. Is this the beginning of something troubling? Well, it turned out to be the case back here in the tech wreck. Is this troubling? Well, it turned out to really be a problem kind of already when we were in the recession and all that. I think the S&P 500 was down 20% through September of 2008 before Fannie and Freddie blew up and before Lehman blew up. So we had pretty much a standard bear market, very moderate bear market up until that point, and then they blew up. The surprise was that the government didn't come in and bail out Lehman. That was the big surprise. And then the other thing that happened is I think it was early in 2009, Larry Summers, the know-it-all, said that we're going to have to force the banks. If Obama was coming in and he was going to be his economic advisor, and he said that the banks would probably have to cut back on dividends and pay de minimis dividends, and so the bank stocks got absolutely annihilated. So that didn't help matters. But I digress here. Let's move on here. We had another tightening here. This was energy. The price of oil took a dive, and a lot of the energy bonds looked vulnerable. So that was an issue back here. This was the pandemic, and here everything's cool, no problem whatsoever. This is a moving average of the spread, and you can see that it's like 350 basis points. Sorry, that's the spread. I got something wrong here. I think I'm going to have to double check that because the spread looks higher than that. Looks more like 450. So I'm not sure what's going on there, but I'm very sure about the actual numbers here. And the actual numbers here is that the spread has actually come down. So stay tuned and I'll fix this chart for next time. Meanwhile, the Bitcoin's all-time record high. This is the red line is when the Bitcoin ETFs were approved by the SEC. And so it's been up and away since then to record highs. Kind of looks like NVIDIA. We've got gold prices going to record highs. I've been getting a lot of questions of why gold is suddenly doing so well here. Inflation's coming down. Is it just because the Fed's lowering interest rates? It's hard to imagine that's the case. It could be that central banks are loading up on gold. Could be the Chinese. I don't know. I really don't know. But it's another sign of risk on kind of trading going on. Then last week we learned that U.S. household net worth rose to an all-time record high, over $150 trillion. Again, half of that, $75 trillion, is held by the baby boomers, and they're retiring. So it makes for a pretty powerful reason why consumers aren't going to suddenly retrench when they run out of excess savings. And that's the excess savings story. My story is that the savings rate is going to remain low for quite some time. And the reason for that is because of the baby boomers are retiring. They're not saving anymore. They're living off the interest income, dividend income of their assets, and they're probably living off the assets themselves. And then maybe some of the younger folks figure that when the parents don't spend it all, there'll be some inheritance left over. And so I think the savings rate's going to remain quite low for the roaring 2020s, which means that consumption will be driven by disposable personal income. It won't be reduced by people saying, I haven't saved enough. So let's have a look at a couple of your questions here. Let me stop the sharing screen. Okay, good. Oh, okay. I don't know. Was it something I said, Max? Okay, let's see what we got here. Barron's front cover curse. Article argued for a broadening out of the bull market thanks to the persistently strong economy, Fed cuts or not. Yeah, I was quoted in there and remained bullish with a 5,400 target for the S&P 500. But on the other hand, can't ignore that the bull's horns at least made the front cover of Barron's. So I did write it up in a QT, in a quick takes. And I'm not sure if it's a valid contrary indicator because it is a bull on the front cover of a major financial magazine, but the editors are pretty clever. They just show the horns kind of piercing this big sheet of white paper, and you don't see the bull's face. So I don't know where that stands in the realm of contrary indicators. I would point out that on October 27th of last year, Barron's had a great cover story, claiming that we were seeing the peak in bond yields, and that turned out to be a very correct story. Maybe that was contrary at the time because there were still lots of people talking about rates going a lot higher. Jamie Dimon was talking about 7%. So I'm a big fan of contrary indicators, but you have to take them with a grain of salt and just one of many indicators to watch. Of course, the optimism indexes are all extremely elevated. So from a sentiment index, and I would view the front cover as a sentiment indicator. So the sentiment indicators certainly are saying that waving a caution flag here that we could have at least some sort of mini correction. By the way, I forgot to mention it's going to be hard to knock NVIDIA down much more, given that next week on Monday, the NVIDIA is going to hold a convention in San Jose. I think it's 2 or 3 days to discuss all the wonderful things that AI is going to produce. So it probably should be pretty awesome, and it could hype things up a bit. But I guess it'll be very interesting to see, and it'll be maybe important to see how the NVIDIA and technology stocks respond to that convention. Because if it turns out to be a non-event for the stocks, it may be that there's a lot of good news already baked in, and there's still some skepticism about, not that AI isn't going to produce some improvements in productivity, but how widespread are they going to be, and how soon is it going to be? Again, I would point out that I think self-driving cars are kind of an artificial intelligence, and Apple, after spending billions of dollars on it, decided that they didn't want to play anymore. There's a good story in Business Week on Apple's spending on these cars and then backing off. Chip, as per your observation that rates 10-year look to have normalized post-GFC, GVC, revisiting history, what was your opinion about ZIRP and negative real rates for some 14 years? Was this the culprit that fired up inflation? No, I don't know. I mean, I've come to a very sort of practical, empirical view of inflation, that it's driven by a lot of factors. Monetary factors are one, fiscal or another, but supply chain disruption certainly could matter. I think that for all the stimulus that's been poured in, if you have a country like China experiencing a major property depression, and that's deflating global goods prices, you got to factor that in. You just can't look at M2 in the United States or even M2 in China and conclude that there's no deflation risk. It looks like it's all inflation. So I like to take it pretty empirically and try to really fathom what are all the factors that matter and are driving inflation. But I think I have to say that the fiscal stimulus of 2022 from the Biden administration was probably one of the major drivers of inflation, but so was a lot of pent-up demand coming out of the pandemic. Joe, what's your thoughts on the Fed ending the BTFP today? I don't know about today, but yeah, they might do that. There's still, every now and then a mole pops up, and so they may want to keep the banking facility intact. But I'm not tuned to the gossip that's out there. It sounds like you're saying there's some scuttlebutt out there about it being ended, which would be a healthy sign that their perception is things are okay. But or maybe they just want to get everybody to use the discount window instead of using this facility. I'll take one last question. Dr. Yardeni, what is your base case for Fed cuts, timing, pace? Thank you very much. Okay. All sorts of glowing words about me after that. Anyways, by the way, that's the first Oscars that I watched from beginning to end. I thought it wasn't as bad as they usually turn out to be, and I thought Jimmy Kimmel was. I give him like a C plus, but I thought the joke about the review of his performance by Trump, I thought that's pretty hilarious. Fed rate cuts. Still thinking two, maybe three, but really edging more towards two between now and year end, more likely in the second half of the year. But given more, thinking more about the possibility that there'll be no rate cuts at all because they're not really needed. Again, if I was doing it, I would not be signaling rate cuts. I wouldn't be planning on rate cuts. I'd just be watching the data, and if the data said, you know, we really have a problem with the labor market suddenly weakening dramatically while inflation's come down, then I would certainly start to signal that I'm thinking about a rate cut. But I wouldn't have done what Powell did. But again, it's irrelevant what I should have, could have done. It's more important what he's doing. And what he's doing is signaling that there'll be rate cuts. But I don't think he's talking about more than two or three. But it'll be very, very interesting to see what the summary of economic projections has to say. Well, thanks for sticking with me for an extra 5 minutes. I try to keep this to half an hour. Never managed to do that, but not too bad all in all. Look, have a great week, and we'll see you next week. All the best.